One of the biggest risks in development is it's so far out that you really need to be thinking about what's the market going to be like 5 years from now, right? So when you start a project and you're in the pre-development stage of it, that's 18 months to 2 years easily, right? Then you 18 months to 2 years to build it out, and then you've got to rent it and stabilize it, right? So it's a 5-year process. So it's like saying, okay, what's the market going to be 5 years from now?
This is episode number 13 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage.
And welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, Dealmakers? Julian Sage here, and in this episode, I had the special honor of speaking with Chris Finlay, founder of Lloyd Jones, a real estate investment, development, and management firm that specializes in multifamily and senior housing throughout Florida, Texas, and the Southeast. Lloyd Jones currently has 5,500 units and $750 million of assets under management, and since 1990, Lloyd Jones has developed, owned, and managed approximately $1.1 billion in total multifamily housing. In this episode, Chris shares his journey of brokering to development to value add and how he's been able to strategically place his companies through each market cycle to always come out stronger than before. If you like my show notes for this episode, go to multifsuccess.com/13, or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, Dealmakers, to another episode of Multifamily Success Stories. In this episode, we have the special honor of speaking with Chris Finlay. Chris, would you please introduce yourself to the Dealmaker community and let them know who you are and what inspired you to get into multifamily investing?
Sure. Yeah. Well, thank you, Julian. Great to be on your show. And we've been in this business for a long time. We're just celebrating our 40 years in the business. So it's been quite a journey.
Yeah. Do you mind giving kind of a brief synopsis of where your business is now?
Currently, we're focused on multifamily and senior housing, and up until I would say the past 10 years, primarily focused on multifamily value add. And everything we do is via joint ventures, primarily with billion-dollar family offices and institutional investors on a one-off joint venture basis.
And so you have about 5,500 doors, $750 million assets under management. Obviously, this is a pretty, very sizable portfolio, but you didn't start that way. Can you kind of take us back to when you got first started into real estate and how you ended up to where you are now?
Sure. Yeah. So, started out, I was an airline pilot for Eastern Airlines. And, while I was flying, I was also interested in investing in real estate. My father-in-law was in the business. So, obviously I got exposed to it and made a few investments and got hooked. And so, somewhere around, I'd say 75, 78, I started working for a company. I was based out of New York at the time and lived in Connecticut. So I worked for a company called William Pitt in Stamford, Connecticut, and in their commercial group, and started learning the business. And then in 1980, I moved up to New Hampshire, and we started the Finlay companies at that time. And we really had sort of three focuses at that time. We were on the service side of the business and strictly focused on commercial brokerage. We had a very big appraisal, MAI appraisal division, and also a property management division. So we weren't investors. We were providing services for, brokerage, appraisal, and management services. And we did that through probably, the next 10, 12 years. And then we got started in development.
So you said that you got really started in real estate in 1975 was when you purchased your first properties?
Yeah, well, no, I didn't purchase any. I went to, I basically worked for a commercial brokerage firm as a broker. So I was, learning the business from the brokerage side. And then in essence, 1980, I formed my own company and, started out as a broker as well. And really, we weren't investing at that time. We were purely providing services, and and grew a very sizable brokerage management appraisal business in northern New England. We had 5 offices. We had about 150 people working for us. So it was, grew it to be quite a big operation.
So when you said you were interested in real estate, what led you to joining a brokerage as opposed to going out and getting into flipping homes or investing in a joint deal? What led you down this path?
Yeah, I think brokerage is a great way to learn the business. So I think you get exposed to the market, you get to see a lot of deals, you get exposed to underwriting and so forth. So I think it's a very wise way to sort of get exposure. It's either you get exposure through working for another investment firm, or you get exposure through being a broker. And either one of those avenues are very good. Maybe brokers even better because they see a heck of a lot more deals than we do, right? So they get a lot more exposure to the marketplace, what's happening, who's doing what, and so forth. So I think it's just a great way to learn the business.
So what was the reason? So you said that you didn't just do strictly brokering, but you also did the loans as well and the management?
Yeah, no, we did appraisal. So we had a very big appraisal shop, and then we also did property management. Yeah, so all 3 of those services.
Is that a common thing for brokers to kind of branch off into, or was that something that you saw an opportunity to expand your offerings?
Yeah, a lot of the big firms, I think, CBRE and Chris Finlay, all of them have appraisal divisions. Most of them have management divisions as well. So, and in that time, we weren't strictly residential. We were all asset classes. So, retail, industrial, office, multifamily, land. We did pretty much all of the asset classes from a brokerage point of view and from a management and appraisal point of view.
So you said you grew this. So you started this company, and then you grew that for around 12 years. You were offering these services until you decided to get into development.
Yeah. So back in the 1980s, in the late 80s, we went through like 89 and early 90s, 90, 91, 92. We went through a major real estate depression. I mean, it was far worse than what we experienced in 2008. So, you may have heard of the RTC and the S&L crisis that occurred back in that time. So, that totally decimated the business. And unfortunately for us, we were in a very good position, and we became one of the largest asset managers for the FDIC in the Northeast region. So in the late 80s, early 90s, we really were asset managers handling portfolios of defaulted loans and properties that the FDIC took back because they were shutting down all the banks. I mean, it was pretty amazing. I mean, it was like 1929 over again, all over again. I mean, think of it this way. In New Hampshire, they shut down 80% of the banking of the entire state in one day. Unbelievable. Just unbelievable. And, Boston, they were shutting down major banks, Bank of Boston, Shama, Bank of New England. I mean, these were big banks that they would come in and just shut down, take over. And then all of the assets of those banks, they'd call us up and say, okay, take over those assets. So we'd get about 48 hours heads up on taking over, like this coming weekend, we'd be taking over 20 assets or 30 assets for some bank. And it was a pretty amazing time, quite frankly. But fortunately, being in the services part of the business, we were, we're tragically, most owners and developers and investors were wiped out and totally wiped out. And fortunately for us, we weren't on that side of the table. We were on the services side of the table. So we did very well. We grew during that period. And then in the early 90s, I got restless and I wanted to do something, more fun. Asset management is a tough business, and especially when times are hard. I mean, you see a lot of pain. You realize, you talk about learning about mistakes. I mean, you get to see a lot of mistakes and hopefully learn from them. So, the early 90s, we decided that we wanted to get into the development business. And really, during that time, the only things that could be financed were, low-income tax credit housing, which is, federally sponsored tax credits. And they have, state agencies that provide debt for that, because there was no debt. There's absolutely no money available. There's no equity. There was no debt in the entire marketplace in the early 90s. So we decided the only asset class that we could get financed, get debt and equity for, was low-income tax credit housing. So we got into that business, and we started out, doing 2 or 3 deals in New Hampshire, and then we expanded that throughout the country. We became one of the top 5 tax credit developers in the United States. We developed like over 40 of those projects throughout. And then we also developed, United States Postal Service facilities on a build-to-suit and lease basis. So we built them and leased them back to the post office on a 20 or 25-year lease. And when you have a 20-year irrevocable government lease, even in tough times, you can get it financed. So that's the one thing. When you walk in with a lease from the federal government, you can normally get that.
So going back a little bit, so you were doing brokering, appraisals, property management. It sounds like the property management was something that really kind of took off for you. How did you kind of juggle those 3 different services that you were providing, or were you providing all of them and growing all of them at the same time equally?
Yeah. So during that period of time, especially when the market went down, all of them were booming. So think about this. Anytime there's the market goes down and banks have to reappraise all of their assets, and so appraisals are booming, right? So anytime that happens, banks have to get updated appraisals in order to justify the value of that loan on their books. So the appraisal business was booming. Our management business, because of properties being taken over by banks and so forth, they needed somebody to run them. So that was, and then part of our taking over those management assignments, they were really more asset management assignments where we were responsible for taking over the asset, managing it, sort of restructuring it, trying to lease it up, and then eventually sell it. So all 3 of those were, going very well at the same time, fortunately. Now, if you were a developer, if you were an investor, if you were an owner during that time, it was a very, very tough time.
So really, you came into the business it was kind of that perfect time where, and it sounds like you really had that kind of perfect relationship. How did you even get, how did you even work with these banks to be able to, have this kind of self-fulfilling cycle of properties? Is that something that like anybody that has a brokerage or management company can set up those relationships, or was it because of something that you did?
Yeah, I think the answer to that question is we had a pretty sizable operation. I think it was advantageous that we had all three of those functions that we could provide. So rather than having a bank go somewhere here for this, somewhere there for that, we could provide the whole suite of services. And I think another thing was, since we weren't investors at that time, we didn't own a lot of real estate. The FDIC had a rule that if you defaulted on a loan of 50,000 or more, you could not work for them. So anybody that had any kind of default, couldn't get that business. And unfortunately, everybody in the business was in trouble. So, through no fault of their own, I mean, the market just collapsed, and it was devastating to a lot of people. But since we didn't own very much, we lucked out.
So why, if you have such a good thing going for you at the time, why change it up and then move away from that into development? Or did you keep those still both going simultaneously?
Oh yeah, we kept that. Yeah, we kept it going, and for probably another 10 or more years, and then we started growing the development business, and the more we got into development, grew that side of the business. Development is a lot of fun. I mean, it's very creative, and so that took up probably 90% of our effort at that time. The rest of the company was there, and it was sort of like on autopilot. We weren't continuing to grow it, and there wasn't a big growth spurt at that time. But development was, especially in the arena that I was in the low-income tax credit housing business, that was expanding, quite a bit, and so we were able to grow that development business, rapidly and do a lot.
So at this point, when you decided to get into development, was this after that that recession where people were gaining confidence again and there was more money being pumped in, or did you just find this as a prime opportunity?
Yeah, no, it was it was early '90s that we got into the development business, so it was still, I would say, towards the tail end of that. They call it a recession, but it was, for real estate purposes, depression. And so it was still a tail end of that. But from a development point of view, we just got started ramping up. So the business and the development business took off, and the market corrected and started to come back. Probably, started recovering. I would say probably 93, 94, 95 started. So, but I mean, it was devastating. I'll give you an example. Land values dropped 90%, 90%. Okay. Retail shopping centers that were unanchored would drop 80% in value. I mean, these are just, it was a major, major devastation in the real estate business. It was pretty amazing. So, we got to see and learn a lot.
So, I mean, you saw so much devastation. Why jump into development, and why this specific niche as opposed to what everybody else was doing at the time?
Yeah, so the interesting lesson that I learned during that time was when you see all of these asset classes crash, right? And the worst was raw land, right? Second was probably, I would say, unanchored retail was probably the second biggest hit. But everything got hit. But the asset class that took the smallest hit and maybe dropped, say, 30 or 40% value was multifamily. So multifamily, really got my attention in the sense that, hey, in the worst of all cases, I mean, this was an unbelievable situation. Anybody that was around in that time will tell you that it was probably similar to and as bad as the Great Depression. And so, from a real estate point of view. So when you look at that asset class and you say, hey, yeah, there were some foreclosures, but a lot of them made it. mean, a lot of them survive. So so you see an asset class like that that holds up better than anybody else, and and so that's where I said, hey, that's where I want to be. So then, at that time, I didn't have the capital to buy it, go out there and buy that stuff. So we went after developing it, and because of the tax credit program, you don't need a lot of equity and you don't need a lot of capital to go in there and develop that kind of product at that time. Because when you get the award for the credits, you sell those tax credits and that gets you all your equity. And then usually the state and the federal government have loan programs that give you very advantageous loans in order to develop affordable housing. So basically it's a way to get into development with very little capital and and start the business. And we grew it to a very big business.
And while you were so you would develop these properties very affordably, and then you would also manage them?
Correct. Yeah, manage them, and you have to hold them. The tax credit requirement is you have to own them and maintain them for 15 years. The tax credits burn off over a 15-year period.
Okay. So you sold off all of those properties a little while ago?
Oh, no. In many cases, I bought out my partner, who was my tax credit partner. So your partners on these deals are usually Bank of America, J.P. Morgan, major. AIG was one of my big partners. Did a lot of deals with them. And at the end of 15 years, the tax credits are gone. They're in there for the credits. So to them, it's not a real estate investment; it's a tax investment. So so they buy the tax credits, and for them, that's the whole investment. And so at the end of 15 years, they want out of it because they don't want the real estate. So then we get to buy them out, and then we keep the asset, and then I'll keep them forever.
Very nice. Wow. What was? I mean, that sounds like something that would be very challenging. I mean, you have a really well run business, and now you're going to be pivoting into a different, a completely different kind of sector. What was that like? How did you pivot your business so quickly from the services to development? Did you have like pre-existing relationships, or did you have someone that was coaching you? Like, how did you move into that?
Yeah, no, we just got in there, and it was basically learned by trial and error. And we started very small. The first projects we did were, I think the first two deals we did was a 7-unit building and a 9-unit building. So those were sort of my test cell. And then we went to 50-unit buildings, and then we went to all the way up to 500-unit buildings. So but we started very small and learned the business and, made the mistakes on the small ones.
Was there a lot of other people that were doing a similar strategy to what you were doing?
No. And there still isn't. It's a very complex, the whole, affordable tax credit part of the business is a niche business. It's very, bureaucratic. There's just a huge amount of bureaucracy that goes along with it, and it's you might say a lot of brain damage. So there's only a small group of developers that even get involved in it.
So why would you do that for your first choice of getting into development? Just because of how cheap it was, you were willing to suck up the pain of learning how to do it?
Correct. Yeah. I mean, you don't need equity. You can have very minimal equity and get into developing and grow a development business with, otherwise development takes a lot of capital, takes even more capital than an investor, right? So you've got a lot of money out before you start getting any money back in. So, unless you're fortunate enough to have all that money, you don't get to start out that way.
So how long did you have that tax credit development business going for?
Yeah, we did that all the way through 2008. We finished our last project in 2008, which is a major two-block redevelopment in Orlando, the city of Orlando. So we had two city blocks that we totally redeveloped into a, senior housing, family housing, for sale housing component. It was a major redevelopment. We had a huge grant from HUD. We had tax credits, tax exempt bond financing. My partner on it was AIG. And, so when we finished that in 2008, then I figured, the market had crashed. I figured, when are we going to develop again? So, so we basically shut down our development operation in, say, 2009. Once we finished that project, I didn't think development would come back for another 10 years. So, so we shut down our development. And then we focused on buying. I mean, there was such a great opportunity to buy, terrific deals at a substantial discount that it made a lot of sense to pivot from being a developer to being an investor at that time.
What would you say are some of the biggest lessons that you learned? I mean, developing, you said two strips of Orlando,
two blocks, two city blocks.
Two city blocks. I mean, that's a lot of development. What are some of the biggest lessons that you've learned dealing with, very bureaucratic, but also, such large projects?
Yeah, I mean, there's more lessons than I can say in an hour, probably. But development is a very high risk business. I mean, it's just extremely high risk, and one of the biggest risks in development is it's so far out that you really need to be thinking about what's the market going to be like 5 years from now, right? So when you start a project and you're in the pre-development stage of it, that's 18 months to 2 years easily, right? Then you 18 months to 2 years to build it out, and then you've got to rent it and stabilize it, right? So it's a 5-year process. So it's like saying, okay, what's the market going to be 5 years from now? We don't know, right? Have no idea. So the tough part about it is, figuring out where that market is going to be. And the good thing about the tax credit, low income tax credit part of the business is the demand is beyond, way above the supply. So that in that case, if you build it, there's going to be tenants. You're going to fill it, and you're going to meet your projections from an income point of view. So then you're dealing with primarily development risk, which is, can you build it on time? Can you build it on budget? Are there any? We got it, that specific deal. We got into the deal. We had a full environmental study. And, within about 2 weeks of doing the site work, we hit some oil drops. So then we found we had an environmental problem. It took us, a year to complete that cleanup. So we basically had a major cleanup. It had to take 3 feet of ground off 2 city blocks, and then replace all of that, and deal with all of the regulatory environmental stuff. So that's what happens in development. That's welcome to the development world.
Were there ever any projects that you did where it was just like, I don't know, I don't think we're going to be able to finish this? Like you see in China, like how they're developing all these giant buildings, and then they have literally cities that are like half developed. Did you ever feel like, okay, this is never going to work out, and what they're asking for us, we're never going to be able to complete it? So anything like that ever happened to you?
Yeah, no, it's not that we ever didn't complete something. I mean, we complete it, but you pretty much have to complete these deals because you've got a personal guarantee on these things. So, but that doesn't mean to say you're not going to take a hit, and suffer some major, major financial losses in order to get it done. So you get it done, but you may take a hit doing it, and
And
that happens.
how do you account for those things? Like, you said, you found oil and then now that delayed the project a whole nother year. Like, how do you even put that into your projections?
You can't. It's not in there, So you have to go right back to the drawing board and restructure everything and figure out how to make it work. So, and there goes a lot of profit.
Have you ever walked away from these types of developments where it's just like there was really nothing in return at the end, or did you always kind of come out just a little bit ahead?
No, I mean, I think you come out on when you hold these things, 10 or 15 years, you do okay. It's at the time where you don't do okay. So, you may have to take a hit in the short term. In the long term, you hopefully make up.
And when those situations come up, do you have to like restructure the deal? Are you like raising capital to be able to fund the development?
Yeah, exactly. I mean, yeah, you have to restructure the deal. You have to maybe go get more tax credits. You get more grants. You get more funding from all the variety of sources. So, yeah. And, the good thing is when you're talking about affordable tax credit housing and low income housing, usually when you're doing these things, the municipalities are involved. So in the Orlando deal, for example, we had the Orlando Housing Authority and the city of Orlando. So all of those agencies and city really want to see the project done. And so, even though unfortunate things like that happen, they're there to figure out a way of okay, how do we make it work now?
What are some of the other benefits of this form of development? I mean, because it sounds like you're very connected to the local counties, maybe even politically. Are the other benefits to this more than just let's say getting in cheaply and then having a property that you're able to hold?
Yeah, no, I mean, look, it's a very complicated uh, part of the development world, finance wise. I mean, it's extremely challenging financing wise. I mean, you could have you know 6 or more levels of debt and equity in the deal. So it's not like a chunk of equity and a chunk of debt. You could have equity from 3 or 4 sources. You could have debt from 5 or more sources. So so it's extremely complex from a financing point of view. But it's rewarding. You're producing housing for usually very low income people that obviously wouldn't afford to be able to live in that. And believe it or not, it's built and developed to a very high standard. So anything we did, I'd be happy to live in. I mean, they're really nice. They're absolutely as good as market rate and maybe better. So so it's rewarding from that point of view.
And so you said around 2008. I mean, again, kind of that good timing where you just decided to stop the development. What you said, you then moved into purchasing properties. Was your strategy, was this completely kind of new to you, or did you already know, like, because of your experience managing and developing, like, okay, I know the types of properties that we have to get in and fix them up?
Yeah, I mean, we certainly knew the business from a management point of view. So, in 2008 to 2010, pricing was amazing. I mean, there was a lot of distress in the marketplace, and we just saw assets that you could buy well below replacement cost. You couldn't develop them for anywhere near that kind of money, and so it was much a lower risk profile to just look at good properties. We still focused in the B and C, what we call workforce housing type products. So we were still we never got into the high end part of it. We just focused on the workforce housing side of it. But instead of developing it ground up, we would buy existing properties, do it on a pure market rate basis with our capital, typical debt, Fannie or Freddie debt, and do renovations to them and improve them. And they're great assets. And turned out to be a fabulous time to do it. Right. So wish I'd done more.
And were you raising capital for these properties?
Well, we did that all. We primarily did that with our family capital. So initially, from say 2010 to 2013, we deployed only our capital. We had no outside partners. And then in 2013, we made the decision. We deployed most of our capital. So we said, hey, we've got the infrastructure in place. Why stop? And so at that time was the first time we've ever decided to go out and raise capital from other sources. So, and that's really the reason we decided to, form a new entity called Lloyd Jones. And, so that there'd be a separation between the Finlay assets and the Lloyd Jones assets. That's how Lloyd Jones came about.
How many properties did you have in your portfolio before you decided to start looking for outside capital?
Yeah, probably about 18, 20, maybe.
18, 20. Okay. What was the big difference from, just you having complete control and using your own capital versus now you're going out and you're raising capital?
Yeah, it's a whole different world, right? So very, very difficult to go out there and be calling on on family offices or institutional partners, and it was totally new to us. But we've been around a long time. We've got if people knew us, we were a well-known commodity, and so it was pretty easy to get in the door, and I think most people realized we knew what we were doing. So when we presented investment opportunities, we normally got a good hearing, and most of the time we're successful in raising the capital.
What are some of the lessons, the big lessons that you learned when you first started trying to raise capital to when it was just like, okay, I think we've got our stride down?
I think the the difficulty is that when you're doing joint ventures like we do, and most of our transactions I would say are in the $30-50 million size. So you're looking at raising equity from say 10 to 20 million, right? The folks that write a $10 million check or a $20 million check are usually really know what they're doing. And if it's a family office, the patriarch may not know a lot about real estate, but they sure as heck have people that do know about real estate. So I think the unique thing is that these folks really know how to underwrite and really know how to analyze a deal. So instead of previous to that, I'd see a deal, I like a deal, we'd underwrite the deal, I'd say, hey, it's a good deal, let's do it. Now you've got a whole nother side of the equation, which says, hey, I'm not sure we want to do this, and I'm not sure we don't like this, and we don't like that. And, so you've got somebody basically that are questioning all of your assumptions. And so when you're not used to that, if you're out looking for investors, you got to understand that they're going to, especially the bigger the check size, the more questions they're going to ask, right? So, and they're smart people.
Did you ever have any deals that kind of went through that it was just like, to you it made like a lot of sense and you're willing to move forward, but to other people they're just like, no, I'm not seeing what Chris is seeing, and I'm not willing to move forward with this? Any of those types of situations happen?
Oh, all the time. Yeah, all the time.
And what are some of the most common objections that you hear from these family offices?
Well, it depends on their strategy and how aggressive they want to be. In many cases, they may have just bought something, and so you bring them what you consider is a terrific deal, and then you find out, oh, I just bought something 3 months ago, and we don't want too much in one location, So it's there's a whole variety of of reasons why they don't want to necessarily invest. So yeah, but you have to be cognizant of that, and then as you get to learn your investor pool, you really sort of get to know who wants what, who doesn't want, so you get to be able to make pretty good decisions on who will want it and who doesn't want it and the reasons why. So it's just repeat business basically.
With these deals, are you so are you saying with these joint ventures, are you kind of raising it similar to like a syndication, or is that a different structure from a JV to a syndication?
Yeah, no. These are so we call these one-off joint ventures where you have one investor. That one investor is the limited partner. The limited partner is going to write a check for 90% of the investment or the equity, and then I'm going to write a check for 10%. So, so if it's a $50 million deal and we need 20 million in equity, my investor is going to write a check for 18 million, and I'm going to write a check for 2 million. There's one investor and one me. So one LP, one GP.
And what's the reason for the way that for doing JVs as opposed to what most people kind of think of as the traditional syndication route?
Yeah, I think the syndication business is to me a very difficult, very very difficult business, and in most cases you're dealing with people that are not professionals in the business. So they may be a doctor or, business person or whatever. And, so I think it's a whole different game in dealing with those folks. So, yeah, I once had I talked to a doctor one time about, years ago about investing in one of our deals. And he said, well, these returns are guaranteed, right? And I said, well, you guarantee all your surgeries, right? So, you know, I mean, that's what these guys are thinking. So that, the people that we're dealing with are very smart investors. They know the risks. They know how to analyze these things. They're absolute pros. They're not amateurs. So, so they, that's, that makes it a lot easier for me because, they're very smart.
Are you finding all of these investors through the family offices, or like how are you even putting yourself in front of these multi-million dollar investors?
Yeah, it's a real challenge. So there's certainly databases where you can call on family offices and get out there and get in front of them and get known by them. So and when you start doing deals with some family offices, you can use them as a reference for other family offices. Family offices, in my opinion, especially the big ones, are in my opinion, the best investors because they normally have, first of all, they have a lot of money, and then secondly, they have usually a staff made up of very smart people. A chief investment officer, and they have analysts, and obviously they can afford to put together a team that's very very smart and competent. And so you're dealing with pros, right? There's no doubt about it. They probably know more than I do. So so it's just it's great working with people like that, and you hopefully, instead of just me looking at a deal and saying it's a good deal, now I've got my partner looking at the deal too, saying it's a good deal. That's comfort to me as well.
what's your strategy with these partners? Are you, because you said that the partner is putting in about 90% of the equity, you're putting in about 10. Are you just kind of using this as a way to be able to grow the management portfolio as opposed to like what's kind of your strategy with that?
No. I mean, the strategy is make money on the real estate investments. So, management is not a money making venture. I mean, you manage basically to control, but it's certainly not. Unless you get to a very big company, management is not a profitable enterprise, in my opinion. So no, we underwrite these things to achieve a nice return, nice cash flow, and a good IRR. And many of the family offices are very long term holders. So some of them have no exit, so they may hold it forever. And we're sort of the same. I mean, we don't necessarily have to have an exit either. So we could hold assets forever. And we have a number of assets that we've owned for 20, 25, 30 years. So it's we're pretty compatible with their way of thinking.
What are you trying to find, like value add properties, and you're doing the development, or you're doing the rehabs on them, or what's kind of your strategy with picking up these properties that your investors are looking for?
Yeah, it's a good question. So different family offices have different strategies. So some of them want core plus assets and are very yield driven. Some are willing to take a higher risk level and do more value add, more of a turnaround situation, and lower cash flow but higher IRR. So and some are 3-year holds, some are 30-year holds. So it depends on the investor, and so we try to know what our investors are looking for, and then when we see an interesting opportunity, we'll know, okay, this is a short-term deal, it's a turnaround deal, may have a little more risk, but you're looking at a bigger IRR. We'll know who likes that kind of stuff versus very low risk and a reasonable yield and hold it forever.
What are some of the most common mistakes that you see a lot of new real estate investors making?
It's hard for me to say. I mean, I don't see other people's deals that closely. I think it's important that you see a lot of new operators, new young operators out there syndicating these deals with fairly limited experience, and many of them have not gone through a downturn and seen what happens, and in times like you know late 80s, early 90s, and the 2008 to 10 range. And so I think when you've been through and experienced those kinds of downturns, you realize you got to be conservative. You got to be careful about your leverage. I think leverage is a very important ingredient. I think you can be enticed to stretch the leverage in order to get bigger returns. You think you're going to make more money, but instead of making more money, you may lose the deal. So there's a blend there between being too conservative or too risky. But I think leverage is a very important thing. I think 60-65% is where we feel comfortable. Some of our family offices are down in the 50% range. So that's very low risk. And so you really have to be careful of that. And then I think another thing is you need liquid reserves when you take over an asset. You got to have a chunk of money there in case something goes wrong. Because you don't want to pick up the phone and say, "Hey, I'm out of money. We need a couple 100,000 to fix the boiler or whatever." They don't want to hear about that. So you have to do that in advance.
I mean, it sounds like, I mean, you've had a very unique path, going into some pretty unique niches. There's not a lot of people. Are there a lot of people maybe that are working with family offices and doing these JV deals, as opposed to what most people maybe more commonly know about syndications or funds?
Yeah, no, I think you're probably right. I think it's sort of a niche business. I mean, there's joint ventures with family offices, and then there's joint ventures with institutional investors, and obviously there's a lot of them. And so, I don't know what percentage of the market is joint ventures versus syndication. I'm not sure. I would suspect is, certainly on bigger assets and bigger check sizes, I would think it's very much more joint ventures than there are syndications. But but there's a place for both.
If you could go back and give yourself some advice, what would you do differently if you had to start from scratch?
Hmm. Well, tough question. I think I think I've had a pretty good run, and I think it's gone pretty well. Not that we haven't made a lot of mistakes, but none of them have killed us. So I think I think it would have been great if we could maybe when we back in 2010, if we had tried to focus more on raising capital through a fund structure and and selling that to an institutional investors, you know, and doing that versus one-off joint ventures. That that's a possibility, but that's a very tough thing to happen. I mean that's very very difficult. Raise an institutional fund, raise institutional capital, even though we had a long history and a very good track record. Pretty hard to bring that, but I mean it might have been worth the try.
And what's the reason why going JVs as opposed to a fund with your investing strategy?
Yeah, I think it's just much easier to raise the capital on a JV versus a fund. Fund is really really difficult to, especially your first fund, right? I mean, it's just extremely difficult to go out raise capital on your first fund, whether it be through a retail investor or an institutional. It's even harder on an institutional, right? But even retail, going out and raising retail capital for a fund is a very difficult thing. So it's and institutional is even much harder. So they want to be in on the third fund or the fourth fund. They don't want to be on the first one.
I think it's funny, Chris, because you're, I mean, you went into probably one of the most challenging niches, with development, but you're all about, hey, I'm looking for the easiest way to, to build this business. But, with that, that ease, there's also a level of complexity that, maybe most people they don't get into because of that initial hurdle. Do you feel that that's relevant to, your strategy of, growing through this time?
Yeah, I think so. Yeah, it's look, I think we've been doing it a very long time. So I think a lot of people think you just get into the business and raise money and do deals, and I think a lot of people don't realize how hard that is. And so I mean, I take my hat off to you see a lot of these newer companies that have been out there 3, 5, 7 years and have raised a lot of money through syndications and done a lot of deals and hey, good for them. I mean, they've done well and they'd be I certainly commend them for pulling it off. It's not easy, but that's their strategy and I have mine. So
Awesome.
either one of them are wrong.
And what's the best way, Chris, if anybody wants to be able to reach out or find out more about you or your company, how can they get in touch?
Yeah, sure. There's connection on our website and or LinkedIn, and either one of those.
Awesome. Well, of course, we'll include those links in the show notes. But thank you so much, Chris, for taking the time.
Appreciate it. Good to talk with you.
Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.